Okay, good morning, my 111 class. So this is video discussing your adjusting entries topic. So adjusting entries. We have to learn first what do we mean by accrual, of course. So accrual basis means the recognition of an expense already incurred but not yet paid, or the revenue earned but not yet collected. So another thing is that when we have revenue earned but not yet collected, that is actually accrued income. So by definition, it refers to income already earned by the entity but not collected yet at the end of the accounting period. So when the adjusting entries are required, the adjusting entry for this, of course, is accrued income, credit income. So to specify, we have sample, accrued rent income, credit rent income. Or the other way to say accrued rent income is rent receivable. So therefore, it gives rise to a trade or non-trade receivable. Whereas, accrued expenses refers to expenses already incurred by the entity, but not yet paid at the end of the accounting period. So when we prepare the adjusting entry for all accruals or accrued expenses, so we have to debit the expense and credit the liability or payable. So for example, an unpaid rent. So debit rent expense and credit accrued rent expense or rent payable. Therefore, it gives rise to a non-trade payable. For example, if the unpaid expense is light and water, so debit light and water expense and credit light and water payable or accrued light and water expense. Deferrals. So deferrals refers to pre-collection and prepayments. So when we say pre-collected income or deferred income, it refers to cash received but before the services is rendered or goods are delivered. So the account title used for pre-collected income is unearned revenue for service concern type or customer's deposit for a merchandising type of business. For prepayments or prepaid expenses, this is also called the deferred expense. It refers to expenses paid in advance, a portion of which or the entire amount has not expired yet or not yet consumed at the end of the reporting or accounting period. The expenditures that are normally paid in advance are rentals, insurance, advertising, supplies, and taxes. So to record your prepayments, so it depends upon the approach used upon the original entry upon payment of the prepaid expense, which we will discuss later on this video. Depreciation. Depreciation is the expired allocated cost of tangible assets. These assets such as buildings, machineries, motor vehicles, furniture, equipment, and other similar items are long-lived assets that help the business entity generate income and are useful for more than a year. So the cost of the asset is allocated over its estimated useful life, in which the allocated cost is charged to operations called depreciation expense. Uncollectible accounts or doubtful accounts. So it refers to an estimated amount of receivable that is doubtful of collection. This is allowed in accounting to show a better matching of income and expenses. This is compute based on credit sales or revenue for the period or the outstanding accounts receivable balance. However, the credit sales method is used when we deal with merchandising type of business. Solvency. Solvency is the ability of a company to meet its long-term debts and financial obligations. Solvency demonstrates a company's ability to continue operations into the foreseeable future. Whereas liquidity is the ability of the company to pay for its short-term obligations on time or as it becomes due and demandable. Profitability. It is the ability of the company to use its resources to generate revenues in excess of its expenses. In other words, this is a company's capability of generating profits from its operations. Reversing entry. It is a journal entry which is the exact opposite of a related adjusting entry made at the end of the accounting period. This is actually a technique in bookkeeping to simplify the recording of regular transactions in the next accounting period. So, reverse means you do the opposite. But not all adjusting entries are reversed. So we will discuss later, after we discuss adjusting entry, what are the adjusting entries that needs to be reversed. Reversing entry is actually normally prepared at the beginning of the next accounting period. Therefore, this is the first entry that should appear in the general journal. So, let me emphasize that adjusting entries are prepared at the end of the accounting period. So, for example, if your year is January 1 to December 31, so adjusting entries are prepared December 31. Whereas reversing entry is prepared at the next day of the beginning of the next period. So, for example, December 31, 2019, you prepare the adjusting entries. So, the reversing entries is prepared on January 1, 2020 because the end of the accounting period was 2019 of December 31. Salvage value. So it refers to the estimated amount the asset can probably be sold for at the end of its estimated useful life. Salvage value is deducted to get the depreciable cost of an asset. So why is adjusting entries necessary? Adjusting entries are needed in order to measure properly the profit for the period and to bring related asset and liability accounts to correct balances for the financial statements to be fairly stated. So without preparing the adjusting entries, the financial statements may not be fairly showing the solvency, liquidity, and profitability of the entity because there are items in the financial statements which will be misstated or um, overstated or understated. When is adjusting entries being prepared? So as I said a while ago, it shall be prepared at the end of the accounting period. So if your year is January 1 to December 31, so that is December 31. If you have April 1 as the start of your business, so on the 12th month, that is your end of the accounting period. So that's the preparation of your adjusting entry. What are the effects of omitting adjustments? So when there are omitted adjusting entries, the resulting financial statements may not be presenting accurately the financial position and the performance of the entity. So some account titles may declare a misstated or understated or pwede rin naman overstated amounts in the financial statements. So for example, failure to recognize accrued expense. So, if you did not prepare debiting the expense and credit accrued expense, so it means to say that the net profit is overstated because your expense is lacking. So, you declared an expense which is lacking in terms of the expense and credit the accrued expense. And so, as a result, your accrued liability is also understated. Failure to recognize accrued income. So in this case, net profit is understated because you lack declaration of the accrued income. So, for example, the adjusting entry for accrued income is debit rent receivable, credit rent income. So, if you did not prepare that, so understated assets and also understated net income because of the failure to recognize the rent income. What are the effects of omitting adjustments in addition? So, for example, failure to recognize the expired or used portion of prepaid expenses. So, when you did not prepare the adjusting entry for splitting the mixed account of prepaid expenses in which it contains an asset portion and it also contains an expense portion, it will result to overstatement of owner's equity. And also asset is overstated because um, in the prepaid expense you declared, there is already an expired or consumed portion. Failure to recognize the earned or income portion of a deferred income. So the deferred income is also at the end of the accounting period may be um, mixed account because there is a portion that is already earned and there is a portion that still unearned. So if you did not prepare the adjusting entry to split the mixed account, so the net profit will be understated because of failure to recognize the earned portion. And also, liability is overstated because of the failure um, to decrease the amount of the unearned portion to recognize the earned portion. Failure to recognize depreciation. So when we prepare adjusting entry for depreciation, we debit depreciation expense and credit accumulated depreciation. If we fail to do so, our net income is overstated because our expense is understated. So understatement of expense will cause an overstatement in the net income and thus overstatement of owner's equity. Failure to recognize doubtful accounts. So the pro forma entry to recognize doubtful accounts is debit budget expense and credit allowance for budget expense. So if we fail to prepare the recognition for the bad debts, our assets is overstated because we did not have the contra account which is to be deducted to our asset to get the net realizable value of our accounts receivable. So it will also result to overstatement of owner's equity because we failed to recognize budget expense, so our expenses is understated, our net income is overstated, and thus a resulting overstatement in owner's equity. Illustration on accrued expense. Example, unpaid salaries, taxes, utilities, light, water, and telephone, rent. And in addition, also the SSS, PhilHealth, and HDMF contributions, and many more. So, pro forma entry to record these accrued expenses is debit the expense or the specific account title and credit the liability, which is the specific account title. For example, for unpaid salaries, debit salaries expense, credit salaries payable. For light and water, debit light and water expense, credit light and water payable. Or so to say, we have utilities for light, water, and telephone. So, debit utilities expense, credit utilities payable. For SSS, PhilHealth, and HDMF, so debit the salaries expense because these are deducted actually from the salaries of the employees, and then credit SSS, PhilHealth, and HDMF payable. Examples. On December 31, 2019, the company has unpaid salaries of 20,000. Adjusting journal entry is salaries expense 20,000 and credit salaries payable or accrued salaries 20,000. At the end of the year, another example, at the end of the year, the following expenses were still unpaid. Light 5,000, water 1,200, and telephone 1,000. So the adjusting journal entry for this unpaid light and water is debit light and water expense 6,200, communication expense 1,000 for the telephone, and credit accrued expenses 7,200. Another illustration. A 90-day 12% interest-bearing note issued by the company for 50,000 dated on November 1, 2019. Interest is paid upon maturity. Assume the balance sheet is December 31, 29. So the formula to compute interest is actually PRT. So principal times rate times time. So our principal here is 50,000. Our rate is 12% annually. And our time here is 90 days. So standard divided by 360. So it is equal to 1,500. Interest for 1 year is 1,500. The first question is to answer, when is the maturity date of the note? So when shall it be paid? So if our date is November 1, so counting it from 90 days, so therefore it means January 30, 2020. So November 1, December 1, November 1, December 1, January 1, and January 30. So that is 90 days. So the due date is January 30. The next question is, how much is the maturity value of the note? So maturity value is principal plus interest. So if our principal is 50,000, our interest is 1,500. Therefore, maturity value is 51,500. Was there an interest incurred but not paid at the end of the accounting period? So therefore, the interest from November 1 until December 31, 2019, which is equivalent to 60 days, is actually incurred but not yet paid. So your 1,500 is to be multiplied to 2 divided by 3 because 3 months. So or it can also be 60 2 months, so divide 360. So 2 months because November 1 to December 31 is 2 months. So that's why we got the 50,000 times 0.12 times 60 divided 360, that is 1,000. Or it can be 1,500 times 2 divided by 3 months is equal to 1,000. So meaning the 1,000 from November 1 to December 31 is incurred but not yet paid. So we should provide an adjusting entry for that interest incurred but not yet paid. So our adjusting entry is debit interest expense of 1,000 and credit interest payable of 1,000. Illustration 4. ABC Company pays the salaries of employees on a weekly basis. Monday to Saturday is paid on Saturday. The daily payroll for 10 employees is 5,000. December 31 falls on a Thursday. How much is the accrued salaries? So, if December 31 falls on Thursday, therefore, the salaries that is not yet paid is from Monday, Tuesday, Wednesday, and until Thursday. So, therefore, 4 days times the 5,000 for the 10 employees, we have 20,000. So, the adjusting entry for the accrued salaries or the salaries unpaid is debit salaries expense 20,000 and credit salaries payable. Accrued income. So, under accrual accounting, revenue or income is recognized in the accounting period when goods are delivered or services rendered or performed. It simply means the entity shall recognize the revenue in the period in which it is earned, regardless whether or not cash is received. So example, uncollected services already performed or rendered. So accounts receivable. Interest already earned but not collected, interest receivable. The rent earned but not collected, rent receivable. Commission earned but not collected, commission receivable, and many more other related accounts. So the pro forma entry to record accrued income is debit the asset, which is, for example, rent receivable, and credit rent income. So, for example, illustration. At the end of the accounting period, a consulting company has already completed an engagement but was not billed yet on December 31, 2019, amounting to 60,000. So, the adjusting journal entry is debit accounts receivable 60,000 and credit consultancy fees 60,000. Another example, accrued rent income amounting to 5,000. So, accrued rent income, so debit, rent receivable, 5,000, and credit, rent income, 5,000. So, to record the uncollected rental at the end of the period. Another illustration. A 60-day 12% interest-bearing note received by the company for 30,000 dated December 15, 2019. Interest is collected upon maturity. So again, we will use the formula principal times rate times time. And the difference here is that we are the one that receives the note. So, asset on our part. Whereas the other way a while ago, it was notes payable issued. So, meaning we are the one who has amount owed. So, we were the borrower in the previous illustration, whereas here, we are the one that can collect from the note. Okay, so when is the maturity date of the note? So counting from December 15, so counting 60 days, so therefore our days date is Feb 13, 2020. How much is the maturity value of the note? So principal plus interest. So interest is to be computed as 30,000 times 0.12 times 60 divide 360. So that is 600. So our maturity value is 30,600. Was the interest of 600 paid at the end of accounting period? The answer is no, because it will be paid together on the date of maturity. But then, on December 31 is the end of the accounting period, so we will prepare the adjusting entry to record the interest earned although not yet collected. So, to compute the number of days of interest earned but not yet collected. So that's December 15 to December 31. That is equivalent to 16 days. So 30,000 times 0.12 times 16 divided by 360 days is equal to 160. So we shall prepare the adjusting entry, which is debit interest receivable 1,000 and credit interest 1,000. I think that's not 1,000. The amount computed is 160. Okay. Reversing entries. So, till our next video, we will discuss reversing entries. Thank you and God bless.